So an operating cycle, as we talked about in the last chapter, is the time from which businesses begin to spend cash until they receive the cash back. So it is the spending of cash by buying merchandise inventory, by paying their employees, manufacturing items into finished goods, buying the raw materials, and then selling to their customers, and then turning that into an accounts receivable and collect it back into cash. All right? The overwhelming majority of companies do this in under 30 to 60 days. Normally an operating cycle, your terms, which we'll talk about in an invoice slide here in a minute, your terms are normally net 30. So when you send an invoice to a customer, you give them traditionally 30 days to pay it. So by the time you order material, pay for it, start paying salaries and wages to your employees till you get cash back, it is traditionally 60 days. Now, in a grocery store, as they indicate, it could be much shorter because milk and bread and the like are delivered on a daily basis from their suppliers, invoiced, and purchased that same day. So they could have a day's worth of operating cycle. Contrast, an art gallery could have a painting on display for a year before they sell it. A big expensive painting. Jewelry stores, the same item. So it depends on the business. So the difference between service businesses, which we've been doing so far, is they have revenue called fees earned. From that, they subtract operating expenses to come up with net income. A merchandising business has a new account that we haven't seen thus far called cost of merchandise sold, or cost of goods sold. So it's commonly referred to as cost of goods sold. All right? This is the direct expense for the items that they sell. So what did it cost them to buy this inventory in total? And then they expense that to come up with gross profit. So the second and third line is what's new in a merchandising business's income statement. So cost of goods sold, deduct that from total sales, and you get gross profit. So, this is just reiterating. Service businesses are fees earned, and you subtract operating expenses. So the merchandise is sold, it is reflected as cost of goods sold. All right, there are two, and we're going to introduce this, we've got a whole chapter on this when we get to chapter 6, I believe. There are two ways of accounting for inventory: periodic and perpetual. Now, before the advent of computers, almost all businesses did a periodic inventory system. So at the end of each period, at the end of the month, you would go out and you would count how much inventory you have, just like we've been doing with supplies. So you take the beginning inventory, what did you start the month with? You add anything you bought. We use an account called merchandise inventory. That's the purchases of all inventory throughout the month. That gives you goods available for sale. From that, you deduct ending inventory. So you go out there and you count everything. You deduct that from goods available for sale, and that is cost of goods sold. So you do the entry once a month or periodically. Now with the advent, even small retail outlets, the little dive shop that I operate out of here in town, has a point of sale operating. They just buy a PC, load up the software, get a little barcode reader wand, and they ding inventory as they sell it. This is perpetual. So in a perpetual inventory system, when you buy inventory, you're debiting it straight into the inventory account. The inventory account is always updated. And then, as you sell it, there are two entries that occur. There's the entry that we've been doing all along, debit cash or debit accounts receivable, and credit sales, right? That's the revenue side. And you immediately debit cost of goods sold and credit inventory. So under a perpetual inventory system, you can go into your inventory on the computer and see what items you have left available for sale. You should know at any point in time how much inventory you have. All right, so those are the two differences. And we'll talk about that in detail in chapter 6 after the second midterm. So perpetual, the one that you just do an entry once a month, you credit a special inventory account called merchandise inventory as you pay cash for inventory, or you pay for it on account, purchase the inventory on account, and then credit accounts payable. All right, this is a typical invoice. It shows who sold it. They're numbered. They're almost always numbered in some form for internal control purposes. Who it's sold to, what the order number is, what date it is, what date did we ship it. So they ordered it on January the 3rd. They shipped it on the 5th. And they shipped it U.S. Express Trunking Company, FOB Cincinnati. And the company is in San Jose. And then the terms are 2/10 and 30. So what does all this mean? Credit terms are an incentive for your customers to pay you before the 30 days. So 2/10 means if you pay within 10 days rather than 30 days, I'll give you 2% discount. So you pay me early and I'll give you 2% off the invoice total. Otherwise, the remainder is due within 30 days. All right? So if you were to give a 210 for net 30, and that's how it's expressed, is 2/10, comma, and 30, then if you pay, and this is the invoice date, if you pay it by the 15th, you only owe $2,940. 2% off of a $3,000 invoice. That's $60. Otherwise, the full $3,000 is due on the 4th. Now, the reason that overwhelmingly, most companies take this discount is because if you don't take the discount, you're essentially borrowing the interest at 36%. So if you take the 2% and you multiply it by the 360 days, divide it by 20 days, it's 36%. And that's outrageous. So no, most companies don't take that. All right. So the debit is the merchandise inventory. This is once again a perpetual, a periodic inventory system for the accounts payable, the net due. And this is the way most companies account for their inventory. And then if they don't for some reason pay it, then they'll have an expense called inventory discounts not taken. And that's something that no one, board of directors and the like, want to see, because that means you're paying this outlandishly high interest rate for a discount not taken. All right? All right, the other thing that is unique to a merchandise company that the service companies don't have is returns and allowances. You've all done this, right? You've all taken a birthday present back to the store and exchanged it for something you really, really wanted, right? I know you have. No? You've never taken some sweater or pair of socks or something that you got from your aunt? No? That's pretty good. I can't say that. That's a purchase return. All right? If you take something back to the store, they're either going to give you in-store credit or they'll give you cash back, and you have returned the merchandise to the merchant. All right? So if that's a return, what do you think an allowance is? You're HEB. You buy a pallet full of bananas. Big crates of bananas. Inside that pallet, there's one bunch that's gone bad. All right? It arrived past its due date. It's bad. Does the banana supplier want that bunch of bananas back? No. Just throw it away. And they'll give you an allowance, a debit memo, to offset the cost of that one bunch. All right? So if it's too small, de minimis, or it's rotten, where you're not going to physically return it back to the seller, then it's an allowance. That's the difference between a return and an allowance. All right? So this is a typical debit memo. They sent back 10 server interface cards at $90, so they get to subtract $900 from the invoice that was originally shipped to them. All right, so that they physically sent these cards back, returned via parcel post. It was originally on order 825X, invoice 7291. And you get a debit memo. Okay? Merchandise inventory, this is a return. You debit the accounts payable, lowering the liability from Maxim system to you, and you credit the merchandise inventory for the $900. Okay? So just like you had terms, 210, net 30, to pay your suppliers, you also frequently give terms to your customers to incentivize them to pay you faster. And so on those items, you, rather than the $5,000 worth of merchandise inventory that you purchased, you have really purchased $4,900, and then when you return a portion of it, you returned $1,000, but less the 2%, and then you paid the net difference of $3,920. Okay, so sales transactions, debit cash, credit sales. If you have a return on this, you just book the opposite for any returns. On a perpetual inventory system, in addition to that sales, the debit to cash and credit to sales, you book the cost of goods sold and reduce the merchandise inventory by the amount of the inventory that it cost you. Credit cards, those are essentially cash. They're recorded as cash because you get a clearinghouse daily. You get to collect whatever you charge on a credit card, on Visa and MasterCards at least. Okay. Processing fees are just bank expenses that go under administrative. So credit card expense for the month. So here's the combination of the two. Here's the two entries that are done every time you make a sale under a perpetual inventory system. So you debit the accounts receivable for the $18,000 in sales and credit sales, and simultaneously you debit cost of goods sold for $10,800 and credit the merchandise inventory, so that your inventory records always reflect the current balance of inventory that you hold on hand available for sale. And then this is that customer discount. So you're offering your buyer, your customer 2% off if they pay within 10 days. So rather than $18,000, you would debit accounts receivable for $17,640 to net out the $360 discount that you gave them for paying early, paying within 10 days. Okay? And just like you had returns and allowances for the items that you bought, your customers are going to return items also. And so you're going to have customer returns and allowances. So when we go to an income statement, sales are net sales. So the sales that we're going to report on an income statement are net of all these returns and allowances. So sometimes on a very detailed income statement, you'll see gross sales, less returns and allowances, sometimes less terms discounts, and then net sales. Okay? So that's just another way of reflecting that. Okay? So here's a return for, made a sale of $2 million. They returned $25,000 worth of inventory that we sold for $40,000. You take that back to sales, customer refund payable, and return the inventory to stock. Okay. Here's a refund payable, $3,000. You're going to credit cash when you actually pay it, and then put the $2,100 worth of inventory back into our perpetual inventory system. Okay. And here's a credit memo for that. All right, freight. The total cost of goods sold is everything that it took for you to put the product on the shelf. All right? So back to that original invoice, we were buying merchandise inventory when I was talking about the credit terms. There was an item on there that said FOB Cincinnati, which is where the customer, which is where our plant was. So freight can be, and there's a slide here. Freight can either be paid for by you, the purchaser, or by the seller. So who pays for freight? If the purchaser is buying freight, it will say FOB shipping point. That means I have to go and contract a trucking company to go to the loading dock of the manufacturer or the wholesaler where I'm buying my inventory, and then when they load it onto that truck, it belongs to me. All right? I take possession of it, which means I need to insure it to make sure that if something happens to the truck while it's in transit, that my inventory will be insured, and I need to pay the trucking company. All right? That's FOB shipping point. The title passes at the seller's place of business. FOB destination means that I don't have to insure it, I don't have to pay the trucking company, they will send it to me for free. So if you've got Amazon Prime, you get FOB shipping point, because everything you buy from Amazon is free. All right? If something happens to it while it's in transit, Amazon will make good on it. There are terms that can be negotiated anywhere between. If you're making terms to buy something from a manufacturer in China, for instance, it may say FOB Shanghai. What that means, if they're located in the interior at Xi'an or something like that, they have to put it on a truck, and they have to truck the container down to the port in Shanghai. At that point, the port picks it up off the truck and puts it on a boat, and now it belongs to you. You then have to insure it while the boat goes across the Pacific and lands in Los Angeles, more than likely, and offloads it and then puts it on a truck and drives it to your place of business. So these FOBs can be negotiated at any point in time. Walmart, the world's largest retailer. If you go to Walmart with a product to sell, they will only negotiate this, FOB destination. Walmart will not pay for shipping. If you want to sell to them, and they're the 800-pound gorilla, everybody wants to sell to them, you have to take it to them and drop it off at one of their distribution centers. HEB has a contract. At HEB, all the little dog toys and cat toys that are on that shelf there, that's FOB shelf. There's a company that's located out near Shirts in Selma that takes all those items and puts them into crates. They've got an automated warehouse that brings, a whole tractor trailer full of squeaky toys for dogs will back up, and then it gets divided up and put into these little gray plastic bins. No human contact. Automatic. They open up the boxes and they take it all out and put it in these bins. And then every day they load these bins into trucks, and the trucks drive all over the state of Texas from Selma. And they go into every HEB in the state of Texas, and they take these bins out and they put them on the shelf. It's FOB shelf. It's the only way HEB will buy a dog toy. They won't deal with it otherwise. Bread company, the beer company, the milk company, all of that is FOB shelf. Does anybody ever work for HEB? Oftentimes I have a student in here that does that. You work for HEB?
Checker.
Oh, a checker. But the milk guy comes and puts the milk in the refrigerator, doesn't he? The HEB employees don't touch that stuff. Same with beer. Yeah. It's all FOB shelf. So terms can be any kind of thing. But if you're paying for it, if you've got an FOB destination, then the freight is included in the cost of inventory. It's added to merchandise inventory. All right? Okay. This is the main part for the second midterm. Is last chapter we introduced the classified balance sheet. That is current assets and property, plant, and equipment on the asset side, current liabilities and long-term liabilities on the liability side, and then contributed capital and retained earnings for stockholders' equity. So we're classifying by using subheadings. The multi-step income statement, thus far, we've been taking all revenue and then subtracting all expenses. Well, now we're going to break that down into subtotals. And there's 4 of them for a merchandising type business. There's cost of goods sold, deducted from sales for gross profit. Then from that, you subtract operating expenses. And operating expenses are broken down between selling and administrative, or selling expenses, and then general and administrative expenses. That gives you income from operations. Then you add or subtract any other income and expense, items that are not associated with your day-to-day business. So if you're making some interest revenue by loaning some money to your customers, or you're renting unused space in your warehouse or your retail store, all of that's ancillary type income. If you're paying for interest expense, that's a decision by senior management on how to finance the business. So that's not part of the core business. All right? All of those fall into other income and expenses. You take the net of that, subtract it from the income from operation, and that gives you income before taxes. And then you subtract income tax expense for net income. So it breaks down into 4 subtotals: gross profit, income from operations, income before taxes, and then net income. So operating expenses are divided between selling and administrative. Selling is salaries, store supplies, depreciation of store equipment, advertising, delivery expenses. That would be anything that is FOB shipping point, or FOB destination, delivery expenses. And then administrative expenses are office salaries, office supplies, things like that. Okay, so those are the 2 categories. Other income, I talked about income from interest, gains on sale of fixed asset. You sell an old delivery truck. Well, you're not in the business of selling delivery trucks. So you sell it for more than its book value, you have a gain on the sale of delivery trucks. Other expenses that are not in the normal operation could be interest expense, and then losses on disposable. So you sell that same delivery truck for less than its book value, that's a loss on disposal. Okay. So here's the total, and they don't have down here income tax expense. You will have that on your midterm, and we'll review that on Monday. So you have sales less cost of goods sold for gross profit. Then you have total up your selling expenses and administrative expenses for total operating expenses. Deduct that from the gross profit, the first subtotal. You get the second subtotal, income from operations. In this case, they've got some rent revenue, but interest revenue is higher. You only earned $600 in rent revenue, but you paid out $2,440. So the net of other income and expenses is a negative $1,840. Subtract that, you would get income before taxes. Subtract the income tax expense for net income. All right? Well, this we talked about, the classified balance sheet. That's good. Okay, let's do a problem. We're going to do problem 5-5A on page 261. So problem 5-5A on page 261. On this one, it says the following selected accounts and their current balances appear in the ledgers of Claremont Company for the fiscal year ended May 31st, 2016. And it's got a whole series of balance sheet accounts as well as sales and expenses. So prepare a multi-step income statement. So we'll start here. So it's a 3-line header. Claremont Company. It's the income statement. So the multi-step income statement is not the title of the financial statement. It is just the form that you're presenting. So when you're doing your midterm, you don't have to write multi-step income statement or classified balance sheet. It's just the income statement or the balance sheet. And this is for the year ended. May 31st. Start with sales. And in this case, they have $11,343,000 worth of sales. From that, you're going to do cost, and I'm going to go goods sold, even though your textbooks calls it cost of merchandise sold. $7,850. Subtract that from the total sales, you get the first subtotal, $3,493,000. $493. And that is called gross profit. So that's the first subtotal. From that, you'll deduct operating expenses. Start with selling. So you have sales salaries, of $916,000, advertising expenses, $550. Depreciation on store equipment, $140,000, and miscellaneous selling of $38,000. Total all that up, you get $1,644,000 as total selling expenses. Then you have administrative expenses. We have office salaries, of $650,000, rent $94,000, depreciation on office equipment $50,000. Insurance $48,000. And then office supplies $28,100, and then miscellaneous $14,500. Add all that up, you get total administrative of $884,600. Add that to the total selling expenses, and you get total operating expenses of $2,528,600. Subtract that from our first subtotal, gross profit. Subtract that from our first subtotal, and you get income from operations of $964,400. Then we have other expenses. Interest income, interest expense, of $21,000, giving us $943,400 in net income. Show the whole thing here.